Good evening, everyone. Welcome to today's CPD on type of contract, part 2. And as we discussed in the last CPD, today is the final session for the type of contract. And many people attended before as this CPD freely. Today is the last chance for you to learn on this topic. So let's focus and learn today about the different type of contract. So just refreshing what we have discussed in the last class. We have discussed about the advanced QS practice and contract management syllabus. They are the third point in the pre-contract type of contract. In the type of contract, we had a three different contract. So which is namely lump sum contract. Under the lump sum contract, we had a three variant. So the third variant, what we understood in the last class, it's just a theory, and this is no longer a valid theory. And the second, we are going to study today about the measure and value or remeasurable contract. And there we will see three variant. Okay, so first two variants comes under the schedule of rate, and the third one based on the previous similar contract. And we are going to study about the cost reimbursement contract. Sometimes it's called as a cost plus or prime cost contract. There we have a total 4 variant. Okay, so that's how we are going to go through today webinar. And let's start from the measure and value contract. As we discussed in the last CPD, we have understood very well about the lump sum contract, how it's worked. So now we have to understand carefully what is a measure and value contract or remeasurable contract. Okay, so let's go very deeply and let's understand. After that, we will go and see the same question what we have discussed in the last class, and we will discuss under the same measure and value contract, and let's have the good idea how to resolve those questions. So remeasurable contracts, originally it's coming from the red book. If you say the FDIC red book, which we are using under the advanced QS practice program, originality of the FDIC red book standing for the remeasurable or measure and value contract. Okay, so in this particular contract, unit rates are only the part of the contract. So what is that? Unit rates. But when come to the lump sum contract, what was the part of the contract? If you see the total amount, right? The total amount was the part of the contract. So therefore, it is slightly going to be differ from the lump sum contract. So now, why unit rates only form the part of the contract? Okay, do you remember what is the example we have discussed in the last class? City A and the B, and from the destination point A to B, right? You are going to travel, and you had a lump sum contract agreement with the taxi driver. This is what the example we have discussed in the last class, isn't it? So now let's come to the same example. Now you want to travel from the city A to B, but this time you are going to go with the different contracts methodology or payment mechanism. What is that? Okay, Mr. Taxi driver, we are going to drive from there to here to there. So how much you are going to charge per kilometer? How much you are going to charge per kilometer? So this is the point. This kind of measure and value contracts are starting now. Unit rates form the part of the contract. So is it straightforward? Yes, it is straightforward. As per the work done, you are going to pay, isn't it? So say for example, taxi driver, say you agree $1 for 1 kilometer, assume, okay, for a simplicity. Now, if the taxi driver drive 1,000 kilometer, you are going to pay $1,000. If you drive 900 kilometer, how much you are going to pay? 900. Very good. So simple as it is, you are going to measure and pay the amount. That is how this contract got the name. Measure and value. That means measure and pay. Do you understand? So the meaning of the contract itself very understandable. You have to measure the work done and pay accordingly. Okay, therefore, this contract not similar to the lump sum contract. In the lump sum contract, once the work done, are we going to remeasure if the original scope of work done? Do you think? No, we are not going to remeasure. Once the scope of work done, you have to pay full amount. But here in the measure and value contract, we have to remeasure and pay according to the work done. So keep in mind, only the unit rates are forming the contract, not the quantity or not the total amount. Okay, so why this kind of contracts are now entertained? The most of the time, these contracts are very useful when come to the a project where the quantities are not measurable. Say for example, okay, is it possible to measure some infrastructure quantity which is coming like a road works? It's very subjective, right? Say for example, you are going to put the cotton field works in the mountain to build the road. So where the cuts and fill quantities are going to change based on the site condition, or you are going to put the road. Okay, so it is subjective, it cannot be measured. Yes, example, yeah, dredging work where the quantity cannot be measured easily. Okay, or it is impossible to measure. Say for example, um, say for example, um, any works you are going to do under the ground, can we predict what is inside the ground? What is going to be the soil condition? Can we predict? Or think about the highway, okay, from city A to B, highway, okay. Can we take the soil report properly? All the location to identify how the soil condition between it is 1,000 kilometer, impossible. You can take randomly, okay, some number of soil report, but not possible to take entire spaces throughout the roadway. So therefore, it is unpredictable. Therefore, we cannot predict the quantity and the nature of the work. Whereas in the lump sum contract, the works are well defined and the contractor able to give the defined price. But in the measure and value contract, the works are not defined. So do you think if you are a contractor, if the work is not defined, will you give the defined price? Is it possible? No. Let's take a example. Now you want to travel from city A to B. So do we need the exact location from A to B in order to give the lump sum price with the driver? Yes, we need it. You can't just blindly say, I want to travel from city A to B. From city A, which location, to city B, which location? That you have to give. Then only someone can give the defined price. But if you are going for a remeasurable contract, where you don't need to define from which location to which location you are going to travel. Okay, it is as per the work done you are going to pay. So that is the nature of this particular measure and value contract. So signing of the contract and commencing of the work can proceed before completion of the design. Why? Ultimately, I can ask you a question. If your design is already completed, do we need to go for a measure and value contract? If your design is fully completed, your scope of work is well defined, do we need to go for a measure and value contract? No. But why we are going for a measure and value contract? Because the scope of work is not defined. because if you see here, the design development on progress. So therefore, we don't need to have the complete design if you are going for a measure and value contract. So therefore, the work can be started while you are designing the substructure. Okay, you can do the preliminary enabling works. Okay, once you are doing the substructure work, the superstructure design could be done. While you are doing the superstructure work, the finishes and the MEP service design could be done. So this is how the measure and value contracts are works. So what is the benefit here? It is kind of a speed. You don't need to work, okay, and you don't need to wait and work until the design complete. You can do parallelly. So now let's talk about the remeasure contract. We have the bill of quantity, right? Now this is the bill of quantity misunderstood by many quantity surveyors in the industry. They think this is the quantity exactly, perfectly accurate quantity. Is that right? Is it possible? The quantities in the remeasurable contracts are perfect, accurate quantity. Why? Why it cannot be? Because design not completed. If the design is not completed, can we have the defined scope of work or accurate quantity? No, it is subjective. Now think carefully. Any contract signed under the remeasurable contract, can we say the contract sum which is you agreed is a final contract sum, like a lump sum contract? What do you think, everybody? No, isn't it? No. Why? Scope of work is not defined. The contract sum which is indicative is not a final amount unless until the last work is done and you measure and pay, you don't know what is the final sum. So therefore, cost certainty you cannot take from the remeasurable contract. So here the BOQ quantities are estimated but not final. Okay, tell me again. I want to make sure you understand why it is not final. What is the reason? Key reason it cannot be final quantity. Okay, because of the what? Design not finalized. That is the understanding. Okay, so the contractor, what he will do, he will quote the uh, each BOQ light item. He will price the unit rate. That's it. So unit rate is the part of the contract. In the quantity given, okay, is a approximate or estimated quantity. Now, what will happen during the construction period? During the construction, the actual quantity, whichever it happened at the site, you have to measure it jointly along with the contractor QS and the consultant QS, and you take the final quantity. Then at the rate you have quoted in the contract, you have to multiply and you have to pay the amount. Okay, so that's how you are paying, measuring and paying the work which is done. Now let me ask you a question. During the construction period, actual quantity of the works are executed, right? And you have to pay them according to the work done. Now let me ask you a question. We have the BOQ line item A, B, C, D, 4 item. Okay, in the original quantity during the contract, each A, B, C, D 4 item got 10, 10, 10, each 10 number. Okay, so both prices are say even the equal price, 10 number. Okay, say $10. So it's all got 100, 100, 100. Now item A is done 20 in the actual. How much you will pay? Item A got done 20, 200, right? 200, very good. Item B in realistic it done 5 only. How much will you pay? Okay, 50. Item C, it's really done only 75. How much you will pay? Okay. Item D, 0. Nothing happened at the site. The work was not done. So how much you pay? Okay, so you understood. Even though the schedule of rates or prices appear in the BOQ, if the work not yet done, you are not going to pay, because it is measure and pay. Work done, you pay. Work not done, you don't pay. Is the same scenario applicable in the lump sum contract? No, isn't it? We have learned something in depth. And if the people not attended last CPD, I sent you already the video recording. Go through and learn. Okay. So in case of any variation or additional work without any basis of the rate, okay, the rates are not agreed, then what we have to do? We have to build up the new rates. Otherwise, if any rates are existing in the BOQ, to use the same rate in order to evaluate the payment. Okay. So this type of contracts are, fair and reasonable. There's no quantity risk for the contractor. So therefore, it is compared to the lump sum contract. This contract, measure and value contract, the measure and value contract not transfer the quantity risk toward the contractor. So therefore, it is a fair and reasonable type of contract. So what is the advantage? Now you people have understood, right? What is the advantage by going the measure and value contract? We don't need to wait, to start the work. So we can start the site earlier than, while the design is developing. So you don't need to waste the time to prepare the firm bill of quantity. That extra cost is, eliminated. And it is a fair competition. Compared to the lump sum, the risk premiums are very high. Okay. Any variation easily it could be done. Not like in the lump sum contract, the rates will be challenged in the lump sum contract. We have discussed that one. But in this measure and value contract, no, it is not subject to challenge. Everybody go in a way, because it is already this contract standing for the rate only, right? Whereas in the lump sum contract, the rates are standing for amount. So therefore, the lump sum contract BOQ rates will be very challengeable. But whereas in the measure and value contract, rates are not challengeable, because rate is the contract. So any introduction of the variation, additional omission, these things not an issue in the remeasurable contract. So therefore, lower risk went to the contractor. But when come to the disadvantage, the cost certainty or time certainty, not now. So if the employer wanted to have the cost certainty or time certainty, he can go for a measure and value contract. Is it possible to achieve? No, not possible. Okay. So another thing is, in the lump sum contract, works are not remeasured. Only one time you have to prepare the detailed BOQ. When come to the remeasurable contract, every time you have to go to the site, you have to agree the all the item. Is it easy or difficult compared to the lump sum contract when come to the payment? What do you think? Interim payment application or certification, which is easy, lump sum or remeasure? A remeasure is difficult, isn't it, compared to the lump sum? So therefore, you understand the way of doing the payments under the lump sum contract and the way of doing the payment under the remeasurement contract. Is it same? It could be same or not. It could be not same, right? It cannot be same. Why? Many people, okay, say for example, some people worked under the lump sum contract. They had experience how to do the payment and the variation for lump sum contract. When these people went to the remeasurable contract, they think that is a right practice, and they will do the same practice under the remeasurable contract. What will happen? This is going to bring the unnecessary problem in the project. This is happening in realistic, right? The way of doing the payment and variation under the lump sum contract and the remeasurable contracts are absolutely having the different perspective. But many people not aware about that one. So we understood remeasurement should be done every interim payment application and certification. So when come to the commitment of the scope of work, both party don't have the clear commitment. Client don't know how much this project going to be cost. Contractor don't know how much he is going to gain. What is the time for completion? These all are not accurate. And so when come to the tender evaluation, in the lump sum contract, we can come to a conclusion. Whoever submitting the lowest bid, right, they are competitive bidder. But when come to the measure and value contract, we are evaluating the rate only. The total amount which is indicative by the BOQ not reliable. Why? The quantities are okay, estimated quantity, not a final quantity. It is just a dummy quantity, you can say. So the amount which is representing by the measure and value contract BOQs are really cannot define the final contract value. So it is you how to as a QS evaluate each and every rate of the bidders in order to determine who is the uh, lowest bidder or most beneficial bidder to the client. So that is kind of a challenging compared to the lump sum contract. Okay. So now when come to the measure and value contract, we had a 3 variant. So I'm going to explain these 3 variant, then you will understand. We don't need to spend much detail in the later part, the CPD. So please listen carefully. Okay, so you can hear me very well, right? I just want to confirm, and you can see the screen. Okay, so listen carefully. I'm going to give you a proper idea what is a measure and value contract variance, and you remember the one lesson learned bring the next methodology. So one problem we faced in the one methodology bring the next methodology. So in the measure and value contract, we had a first variant based on the schedule of rates. Okay. So under this, we had a 2 different variants: standard schedule and ad hoc schedule. Then we will see what is a based on the bill of quantity that is from the similar previous contract. Now let us understand what is a standard schedule. Let me ask you a question. In the construction, we have the floor finishes, right? Yes or no? There are variable floor finishes available. For example, carpet is a one floor finish. Marble is another floor finish. Can you mention whatever the floor finishes you know from your experience? Epoxy, tile, ceramic. Okay, very good. Okay, marble, timber floor. Yes, wooden. Yeah, same. Screed, not a false ceiling. Okay, granite. Very good. So yes, concrete. So what we are understood here, there are assume that in the construction industry, we have around 10 different floor finishes. Assume, okay, just for a understanding. So what will happen in the standard schedule? Okay, we are not even finalize the design. So client will include all the type of floor finishes, all the type of wall, okay, all the type of ceiling finishes, wall finishes, okay, all the type of doors, windows, everything will be in the standard schedule. That means it is a longest schedule. Nothing missed in the typical construction works. For example, if you are doing the apartment building, right, you know what are the typical item will come under the building. So what you are going to do, you will mention all the item, nothing missed in the market. Now do you understand? It is going to be a very, very, very long schedule. Yes or no? It's going to be a very long schedule. Just floor finishes itself 10 item. So think about all the item that's coming under the typical BOQ. The client will include all the list. It's going to be a longer list, right? So what is the benefit? Definitely, all the item rates are available in the contract, right? Because if you have the longer list, yes. But what is the disadvantage? What do you think? What is the disadvantage if you have the longer list? What do you think? Anybody? Time, yes, but time consuming. Time consuming to price all the item. That is one of the disadvantage, right? So, and the contractor also want to get the quotation from the supplier. If you go and ask the supplier, give me the floor finishes, these 10 different types. Supplier will get confused. Are you kidding me? You are not going to do the 10, item, all the finishes in the project in the simple apartment. So why I should give you all the rates? For him also, supplier also will, reject to give the quotation most of the time. So what will happen? This is a very longer list, and in order to price the each and every item, contractor have to put a lot of effort. Now when come to the tender evaluation, consultant have to put a lot of effort to evaluate them. Now let me ask you, in realistic, if you have the 10 different floor finishes item in your BOQ, do you know as a contractor which item you are going to do really? Is it clarity is there? Very less clarity, right? So therefore, you can't negotiate even with the supplier or subcontractor since you don't know what exact material you are going to use. It's going to be a big problem. So what is the problem here? Why this problem came? A very, very, very long list. That is called standard list. That is called standard schedule. So since we had a standard schedule, a very longer schedule, commitment is not, very well defined. The both parties are confused. What is the work really going to happen at the site? So as a lesson learned, what we are going to do, we are going to build the ad hoc schedule. So what do you do in the ad hoc schedule? Now say assume for example, in the floor finishes, we have the 10 different finishes type. No? So now client coming and telling that hook schedule, we are going to go either marble or granite. Only these two items. Balance 8 item you have to remove from the list. So what happened in the ad hoc schedule? You take the standard schedule, remove unnecessary item, just keep one or two, proposed item. So the list will be lesser. So since the list item will be lesser, at least the contractor will have the forecast. Maybe he can do the granite or marble, but not everything. Okay, so even the pricing also easy and evaluation also easy. So that is called ad hoc schedule. Now what is the benefit? Time saving. Little bit, the commitment is little bit focused compared to the standard schedule. But what is the disadvantage? We got a one disadvantage. What is that? If anybody can guess it? Okay, see, in the standard schedule, all the items are there. You don't need to, very rarely you will go for a rate negotiation for a new item. But in the ad hoc schedule, some items are missed because you eliminated, you removed. So if any item not in your ad hoc schedule, then you have to go for a rate negotiation during the post contract. Okay, that is a disadvantage. Now third one is a ready-made. Okay, third one is a ready-made. What is in the third one ready-made? You just take the previous BOQ, like for example, you want to do the school project, just take the previous school BOQ, remove an unnecessary item, and just give it to the contractor to price. So which is very faster and simple and time saving. Okay, so that is like a shortcut how to do this work, but still, uh, it's going to bring so many issues in the post contract because many item may be missed in the rates. You have to agree again and again with the contractor the new rates, because the most probably compared to the ad hoc schedule in the BOQ based on the previous similar contracts are having limited item. Therefore, you have to keep on negotiate for the new rates. So that is the three variants. So what we understood, say standard schedule have the 100 item, maybe ad hoc schedule will come with the 50 item. Based on BOQ from previous similar contract will come with the 30. It's only the different, okay? Nothing much. So with that understanding, let's go and see a little bit detail on the measure and value contract based on the schedule of rate, okay? So here the bidders are requested to submit the unit rate for a list of items, and the payment to the actual work paid according to the rate you have agreed. If any item newly come, that should be negotiated. So in generally, this is useful for a work where we are unable to predict the quantity, like a maintenance work. Let me ask you about the maintenance work. We have the 30-story building, or there are 98 units apartment building, okay, or 100 units apartment building. What are the general maintenance work will come typically in apartment? You know, if people are living in apartment, most of you, right? So maybe a plumbing issues, right, or electrical issues, maybe air conditioning issue, maybe a damage in the floor finishes or wall finishes or ceiling, or some other socket outlet issue. Like typically we know what are the issues coming, right? Lift issue, very good. Paint issue. Now can we say, can we quantify per year how many number of light fixture we are going to change? Can we define how many plumbing accessory going to damage for a 1 year? Is it possible? Even though you know what is going to happen during the maintenance period, but can you quantify the amount? Is it practicably possible? What do you think? Not possible. So in that scenario only, say like maintenance work, you are not going to go for a lump sum contract because nobody can, you know, predict the quantity. Therefore, you go for a measure and value contract. If the work happen, you will do it, and you get pay as per the rate agreed. Any emergency work, do we have time to define the scope of work? No. Right? Any earth work below the ground, you'll go for a measure and value contract. Okay. So these are the reason the measure and value contract standing for schedule of rate. Okay. So in the schedule of rate, the standard schedule, what we have understood, all the relevant rate heading will be there, right? All the item typically that can come in the construction is a very long list. So the consultant quantity surveyor, there are two way you can price that one. Okay, one is you put the list of item in the BOQ, then you put the amount and ask the bidder to submit the plus or minus percentage. Say for example, you put the item A, and consultant QS will put the price say 100. Now contractor QS put the plus or minus percentage, means they say okay, I will go for a 90% or 110%. That means either he price will be 90 or 110. He will adjust the rate based on the consultant QS rate. That is normally not practicable, right? What do you think? It is normally not much practicable, isn't it? Consultant putting the rate and contractor QS, you know, adjusting it. So what is the second method? You all are familiar. Okay, blank BOQ given without any rate, and bidder have to price it. Okay. So these are the measure and value contract based on the standard schedule and how you price. So when come to the advantage, yes, it's a longer list and you become familiar, and variation not a big deal. All the rates are there, no need to negotiate. But when come to the disadvantage, no cost certainty, right? Tender evaluation will be very longer because so many items, and there's no commitment, understandable, right? What you are going to do in realistic. It's not only that, so many issues we can see, right? And pricing the item also difficult for a contractor. So it is something when to the ad hoc schedule. In the ad hoc schedule, as we discussed, what we do, we remove unnecessary item, keep only the relevant item, and pricing, as we discussed, either by percentage, which is not happening in our region. Okay. Second one, you are going to give the blank BOQ and the contractor going to price. But when come to the advantage, right? Now the previously the 10, you know, we had all the item, but now we had a limited item. So kind of a commitment level is increased. You can understand what is going to happen. Only the relevant item the contractor need to price and consultant need to review. Okay. But when come to the disadvantage, okay, whatever the disadvantage applies in the standard schedule, same here. Plus, okay, sometime you might miss the rate which is you really needed. So that's needed to be again you have to negotiate and agree. Okay, because in generally at work schedule the prices are not there. All the item prices are not there. When come to the BOQ from the similar contract, just take the previous similar project. Can we take the school project, okay, from the BOQ which is coming from the hospital project? If you want to do the school project, can we take the hospital project and do? It should be similar. You understand? Am I audible? Everybody confirm. Okay. So what we understood here, it should be like a pre-priced ad hoc schedule, already readily available. You just take it and use it. Okay. So it's suitable if the projects are repetitive, then you can go for this kind of thing. Okay. So what is advantage? Time is shorter to prepare the tender document. Okay. Only the focus, only the restricted item the contractor need to focus. And tender evaluation also good, but disadvantage same as everything. Commitment, cost certainty, it is not clear. And further, more chance to negotiate the new rates are there. Whereas in the previous standard schedule, very less chance. Ad hoc schedule somehow, but in the BOQ from similar contract, it is more. So now we are in a question. Okay, so my audio is clear. Everybody just confirm me. Okay, so we are going to have the same question what we have. Thank you for the confirmation. So whatever we discuss the same question we are going to discuss here, but carefully you have to answer this time perfectly. And I hope you people should not do a mistake. Can you answer this question? Same question as we had in the lump sum contract. And think logically. What would be the answer? Everybody try to answer. Then only you will understand what is your knowledge level. Okay. So most of you are answering and some of you still need to be answer. Okay. Let me ask you a question. What is that standing the word meaning? Measure and pay. Measure and pay, right? So we had initially when we are discussing the theory, we had a ABCD discussion. And when I say D, nothing happened. What do you say it? Same thing applicable here. In measure and value contract, drawing show 100 number. Is that a final drawing? Tell me, is that a final drawing? No. Of lighting pole, where in the BOQ show 10 number. Is that an actual quantity in the BOQ? No. Engineer instruct the omission for the entire lighting pole in the contract. How do you deal with that one? How much the omission value? Okay, in the BOQ we have the 10 into 10, which is 100. If the job is done, we are going to pay. If the job is not done, which is omitted, are we going to pay? What do you think? Are we going to pay if the job not done? Or are you going to deduct the money from the contractor? Look, contractor, we had a scope of work of lighting pole. Now you are not doing under the measure and value contract. I am going to deduct the same amount. Is it the solution? Everybody think now. So what is the right answer? No cost impact, isn't it? See, it is very simple theory. It's not a lump sum. So many people practice in the wrong way. Okay, they do the same mistake what they did in the lump sum. It is not a lump sum contract. Works are measured and paid. If the works are not done, we are not going to pay anything. We are not going to omit the value from. There's no contract sum in the measure and value contract. Do you understand? That is not applicable under the measure and value contract. That is only applicable for a lump sum contract. Whereas in the measure and value contract, the contract sum, that's not a proper wording. It is just an estimated figure or number. Okay. So in reverse scenario, okay, will you pay for a work which is not done? Which is you had a journey, like you are going to travel from city A to B. Okay. So you supposed to start the journey, but suddenly you got a call and someone, okay, from your family instructor, don't go, come back to home. So will you pay the taxi driver now? You agree the rate, right? You agree the rate with him. Okay, I will pay you $1 per 1 kilometer. But will you pay if you not started your journey? If nothing happened, at the last moment you stopped. Okay, because you had a different plan now. It's the same answer. Okay, same answer. No need to confuse. Many people in the construction. That's what I said in the email. This is a confused topic. A simple one, but confused by many people, and they do the wrong practice. Okay, with that understanding, now let's go to the second question. You will understand further knowledge. We just start with the first question, right? Okay, answer me. What is the right answer here? Everybody have the opportunity to, express your right answer. Okay, so that is a omission. You had a measure and value contract item missed in the BOQ, right? But it is in the drawing. Now engineer instruct the omission for a cantilever. How do you deal with that one? Okay. Now let's ask the second question. Alternatively, engineer instruct the one more cantilever. How do you do that one? How do you price it? What is the answer now? You have to, what do you do? If you don't have the rate, you have to agree the new rate, right? Okay, you are going to negotiate. Now, how will you get paid once a cantilever when it is installed? Say for example, there's no rate, but you did the job, but rate is not there. So how you are going to get paid? Can you answer the last part? Yeah. So the right answer for a first part, okay, you don't need to worry about the omission because you done the job, you get paid. You don't do any work, then you are not going to have the payment. So there no cost impact. But when come to the additional work, even though the schedule of rates or measure and value contract missing the rate, you have to negotiate the rate. So answer is B. And third one, even though your original contract missing the item, but still you done the work, you have to negotiate the rate and agree the rate. So if you see how that differing when come to the payment and variation under the lump sum and the measure and value contract, do you all realize now? We had the same question, right, in the last CPD. So that is how in realistic construction, okay, it's happening. So many unnecessary disputes, unnecessary argument. Okay, so a question, this one. Can you all answer? What is the right answer? Everybody have your opportunity to answer and try your level best. Okay, so now let me give you my perspective. The measure and value contract, BOQ is a final or just an estimated quantity? What do you think? Estimated quantity. So what is the really contract part is a rate, right? Rate is the contract part. Can contractor come and argue? No, it is just for a 10 square meter. When come to the 1000 square meter, I have to go for a different price. What do you think? In generally, okay, no, but sometime yes. Why? Because in this particular question, okay, say for example, you had a 10 square meter, it went to the 10, 20, 30, that's fine. Okay, but there are certain limit. FIDIC Red Book, okay, 1999. Everybody listen, okay, listen carefully. In FIDIC 1999, okay, it is says one place the quantities in these contracts are approximate, whereas in another place same FIDIC 1999 say it is accurate. It is contradiction there, okay. So during the advanced QS practice first contract, we will learn that one where those contradiction coming, you will understand. So even though internationally recognized FIDIC had a mistake within that, or ambiguity within the wording, okay. Now when come to the FIDIC itself, they had a parameter for a varied rate, okay. There are conditional apply. If you are having those conditions satisfied, you can go for a varied rate even though rate is agreed. So in this case, there are possibility because of the quantities are exceed like 100 times, maybe it could be challenge the rate, okay. The contractor or employer can challenge the rate. Maybe employer can get the good rate for higher price, higher quantities. The another thing is, okay, another thing is some jurisdiction, okay, they will say you follow what you have signed in the contract because your contract standing for measure and pay, where your rate is bound, you have to follow regardless what is the quantity. But if you having the conditions like a FIDIC standard, they having the limitation. So what happened actually, FIDIC ruined, okay, even though they have remeasurable contract, okay, the objective of the remeasurable contract, okay, where the quantities are not defined, but they put the limitation how much variance can happen for each and every item, and they had ambiguities, okay. They had ambiguities between the uh, condition itself. One condition say FIDIC Red Book had a accurate quantity, whereas another condition say it had just approximate quantities, okay. So answer is it could be A or B depend on the, okay, scenario where you worked and what happening in realistic, okay. So you have to think with the terms and condition which is agreed and the jurisdiction where you are working, okay. So with that, we will go to the next type of contract, which is cost reimbursement or cost plus or prime cost. Okay, there we had a 4 variant, and we will understand what is this, okay, one by one. So before we starting this particular part of this today's CPD, I will recommend better to have a pen and paper and calculator. If you have mobile calculator, okay, we are going to do small calculation. So are you all ready? Pen and paper, calculator, if possible. Okay, have it. It's much helpful for you all. Okay, so we had a 4 variant. One is a cost plus percentage, cost plus fixed fee, and the target cost and the GMP. So when come to the first item based on the cost reimbursement, have you heard this word anywhere? Reimbursement. Where we use this word in generally? Are you familiar? Anyone? Okay, insurance, refund, expense claim in the company. Very good. In accounting, yes. What you do? You are doing some kind of expenditure, and you are claiming back from the other party. So the same mechanism here. Based on cost reimbursement contract, what happened? The payment mechanism on this particular type of contract is you are going to pay the contractor prime cost plus his overhead and profit fees. So whatever the real expenses happen, you are going to pay as a client. So what is the prime cost exactly? What is the prime cost mean? Or what is the understanding of the prime cost? The prime cost of the labor, material, and plant, which is the basic cost, right? If you all remember, the any rates in the BOQ have the 5M. So one is a machinery, manpower, material, 3M, and money and management. Money is a profit, management is overhead. Okay, so these are the 5M for your short memory if you want to remember. So prime cost for 3M, cost of the labor, material, and plant. So whatever the cost that contractor incurring to hire the labor or hire the plant and equipment or buy the material, he will buy it, he will spend the money, and he will come back to the client and claim the same money with his overhead and profit. So is there any risk given to the contractor on the price here? What do you think? Is there any cost risk given to the contractor? No, right? He is very comfortable, but this is very uneconomical for a client. Okay, now let me ask you a question. Any expenses happen by the contractor, okay, you want to pay back, right? Say for example, for a site, in order to construct the say perimeter wall, you need only 10 labor, okay, 10 labor for 10 days, assume. As much as contractor is spending more money, whatever the money he incurred and paid to the that amount supposed to be claimed from the client, isn't it? Yes or no? Okay, if the contractor bringing instead of 10 labor, he bring the 20 labor for a 10 days, he will make money or not? Yes or no? He'll make more money, right? Which is uneconomical. It is not a preferable. So the more wastage will be there in this kind of contract. And also every time you want to pay the prime cost every month, okay, you have to go very detailed calculation, all the invoices, time sheet for the labor, right? All the procurement records, you have to go and verify and make sure you are paying everything. It's really hard when come to the payment. For a contractor, it is very, very good, but for a client, this is not good. Okay, so it is very, very purely uneconomical, but it is having some reason. We will see what is the reason we are going for a cost reimbursement. Say, for example, some emergency works. Can we negotiate the price to agree the lump sum? Assume that, okay, one highway got a damage by accident. One highway, okay. Can we have the time to negotiate the lump sum price? Or do we have a time to negotiate the measure and value, that rates? So you can go for a measure and value if it is not a highway. If it is a road damage or something happen, repair work, you can go for a measure and value contract. But if it is a highway, I not talk about the subway or small roads, okay? If it is a highway, do we have time to negotiate the rate? You will call the contractor, Mr. Contractor, come and do the work, finish it. And whatever your cost we are going to pay on top of that, we will pay you a profit and overhead. So this is kind of a situation. Don't say all the road damages are or repairs are we are going to go for a cost reimbursement contract. If it is urgency, okay, if something you need to do a repair work very immediately in a fast track, then there's no time to discuss the rates. Okay, so that is a cost reimbursement contract. Another scenario, you had a good relationship with the one particular contractor. A trust is there. You believe he will not going to cheat you. So you will just call the contractor and sign the contract. Okay, whatever your cost you incur, do it properly. I will pay you with the cost plus overhead and profit. But a good relationship should be there. Otherwise, that is not going to work. Okay, this is another scenario why the some clients are going for a cost reimbursement contract. One more scenario also I can tell you. Say for example, some unknown technology. Okay, you are inviting for some unknown technical idea or technical works. Nobody know how to do, what to do. Do you think somebody will give you the measure and value contracts rates or schedule of rate for unknown works? Is it possible? No. So they will fear. So what they will do? No, we will go for a cost reimbursement. Whatever the cost reasonably incurred, we will claim with the overhead and profit. So there are some scenario we can go for a cost reimbursement contract. Okay. So now this is the way it's making. So what is the advantage? You don't need to wait for a BOQ preparation. You don't need to even have the design completion. Straight away you can start the work. Okay. So it is very fast. You need to argue with the design changes or variation. Whatever the cost incurred, you are going to pay. So therefore, it is not like in a measure and value contract. But disadvantage. Most of the time, the cost reimbursement contract is starting without defining the clear scope of work. Therefore, okay, there are time for design and construction. When come to the advantage, there are so many advantage we can say. Okay, the total overall period is reduced, right? Negotiate tendering, you don't need to waste the time for tender evaluation. Okay, changes is very easy. Overlap of the design and construction, there are so many advantage. But when come to the disadvantage, commitment, clear commitment, no cost certainty, no time certainty, right? Cost of the construction is very high. Waste of resources will be very high. Okay, every time the payment or process to pay something, you have to do the verify. That is going to be very, very difficult task in the cost reimbursement. Every invoices you have to check carefully. So under this cost reimbursement contract, we had a 4 different variety, and we are going to see how it was introduced one after one. As usual, I say to you, one lesson learned trigger the second one. Now let's understand what is the cost plus percentage. It is understandable from this wording, whatever the cost plus you are going to pay on top of that a percentage. That is a cost plus percentage. Okay, do you understand? Whatever the cost plus percentage. So percentage you will agree. So advantage and disadvantage, what we discussed before, same like a reimbursement contract, but some other disadvantage. more inefficient will happen, because as much as the contractor spending more money to the project, he will make more profit, right? So more inefficient operation will be there. Resource wastage will be there. Say he need 1,000 brick, he will bring 1,200 bricks. As long as he wasted the money, he will get the profit also, no, along with that one. So the resource wastage will be there, and always client end up paying the good higher amount of money. Okay, so cost plus percentage fee contract. Okay, let's have some example. Okay, now this is the time you have to have your pen and paper and calculator. Now the prime cost. What is the prime cost? Cost for the labor, material, and the plant. Okay, it is assumed 5 million. Overhead and the profit percentage agreed 35%. Okay, so how much we are going to pay them? The cost of the prime cost is 5 million, and 35% of the 5 million, how much? Calculate. Okay, it's going to be 1.75 million. So how much we are going to pay total? 6.75 million. So you understood, simple calculation, cost plus percentage. Whatever the prime cost happen, on top of that, you are going to add the percentage. Now, let's say the prime cost, because of the waste of the material, inefficient operation, it went to 5.6. How much now you are going to pay? Total amount. How much it is going to be? Let us calculate, okay? So it is going to be 5.6. On top of that, we have to add the 35%, so 1.96 million. So we are going to pay 7.56 million. See here, when the wastage or prime cost increase, gradually the overhead and profit also increase, right? Yes or no? So how we are going to control? What is the motivation of the contractor inefficient operation? As much as he wastes money, he will make more profit. So the next lesson learn going to be, okay, cost plus fixed fee, that we will discuss after small example. There, whatever the cost doesn't matter, your profit on overhead going to be fixed amount. Nothing will change. Okay, that is the next lesson. So before we discuss that one, I wanted to, okay, have a small calculation. Okay, so can you all calculate this one? Say the prime cost is 10 million and the overhead and profit is agreed as a 25%. So how much you are going to pay? Everybody, try. Yes, we are going to pay 12.5 million, right? Now I am going to ask you the task 2 question. It is very little bit tricky. Only a few people can answer this. Calculate how much amount you are going to pay here. Carefully see the question and answer, okay? Many people do the mistake in this particular calculation. Okay, let us understand what is this question. Many people don't know Okay, what is the tricky behind this question? If you see above question, look like same, isn't it? 10 million, 25%. Here 10 million, but the percentage are splitted. Overhead is a 15 and the profit is 10. So what is the difference here? Okay, let us understand. Okay, see here, the prime cost is 10 million and your overhead is 15%. So first you have to understand, is your overhead is a cost for you to do the work or not? Yes or no? Overhead, paying for a salaries to the staff, paying the rental, okay, paying the administration fees. Is it a cost or not to run the project? So do you want to make the profit on top of the all the overhead cost? Yes or no? Or are you going to do a charitable things? Definitely you have to have your profit on that one. Because of, see, you had a 25% say cumulatively for overhead and the profit, then you just apply the 25% and you got the 2.5. But when come to this one, many people do the mistake. It's a one of the technique you have to understand. If the contractor say 25%, that is something else. If the contractor say my overhead is 15 and the profit is 10, this is not a 25 what you see in the above. How we are going to calculate? On top of the prime cost, you have to see the overhead how much, and you have to take the total amount. This is your total cost. On that one, you are going to add the profit, which is this amount, and how much you are going to get? 12.65. See, be careful. Huh? If you work for a contractor, instead of say normally the contractor putting a 15% margin, right? Or say your employer, I am going to have 10% for overhead and 5% for profit. Okay, some hidden profit you are going to make. See here, compared to the task 1 and task 2, how much the money increased for the same price? How much different? Around 150,000, right? Different, without do anything. Simple technique. So be careful. If you are a consultant, contractor come with the split, you will not allow probably hereafter, isn't it? So many people not aware this. I know. So that's what I put this calculation. So now let us understand cost plus percentage where the actual expenses, okay, added with the agreed profit margin. So as long as the contractor do the wastage or inefficient operation, he is making more money. So his motto, because of the percentage, he is getting more profit. So what happened in the next methodology? Cost plus fixed fee. Mr. Contractor, do the work, doesn't matter, but your profit is fixed. It doesn't change with your prime cost. So what happened here? The same thing. If the contractor, okay, having the 5 million, he will get the 5.6. Okay, we are not going to change the amount. It is not a percentage 35. It's going to be just 1.75 million. You are going to pay as a profit and overhead. Nothing connected with the 5 million. Now, what happened in the second case? His cost is increased. Okay, say he cost is increased by 5.6. How much we are going to pay? Still 1.75 million. Nothing will change. Okay, so that is called cost plus fixed fee. Okay, so what is the motivation here? Contractor now will reduce the inefficient operation or waste of resources. Why? His motivation to make some profit by spending more. But here, even though he is spending more money, will he make profit? Is it going to change for the project? No, nothing will change. Okay, so therefore he is now less motivated. Even he bring the 20 labor or 10 labor, his profit is same. That is the reason cost plus fixed fee. But still, this is not the okay satisfiable solution to the client, because still the inefficient operation or contractor don't feel the weightage or interest to reduce the operation cost. Therefore, the next technique comes, the third methodology, target cost. What is the target cost? Mr. Contractor, Let's agree something like that. Yes, it is a reimbursement contract, but let's set a target. Say 100 million is a target price. If you complete the project less than 100 million, I will pay you the bonus. If you exceed the project budget, which is target cost, I will do some penalty on you. So they are agreeing the target cost. But until achieving the target cost, same thing, they are going to go with the cost reimbursement methodology only, actual cost to be reimbursed. Okay. So here we had a technique, pain and gain. Okay. Pain and gain, that is a terminology. So pain mean penalty, gain mean bonus. So when you are going for a target cost, you have to agree the percentage for a pain and gain. In general, it will be 50-50. So there will be a problem. Now contractor will come and say, okay, you don't have the scope of work. How we can set the 100 million as a target? So always contractor trying to fix the target cost very high. Whereas always the employer trying to fix the target cost less, as long as less. So there will be a problem, isn't it, to fix the target cost? What do you think? So when they are having the target cost, definitely the scope of works, kind of like an employer requirement, should have the limitation. Okay. Say for example, what I'm saying, you want to build a villa, right? So you talk about the villa, no problem. But after while project is ongoing, talk about the swimming pool or landscaping works around the villa. This is not the part of the scope of work. So they have the limited scopes. Agree in order to set the target. If they are increasing the scope, then you have to increase the target. So with that understanding, let us understand what is the target cost or how the target cost works. So let's see this calculation. Target cost was $60,000, okay? And penalty or bonus 50%. So what is the target cost? 60,000. Now prime cost means actual cost whichever incurred till now to the contractor, 55,000. And the payment fixed fee, okay, agreed 10,000. So how much the total value? 65. Now tell me, what is the target cost? 60, and the total cost of the contract now went to 65. Are we in a gain or pain? Pain. How much excess? How much exceeded? 5,000, right? So what do you do? Excess target is 5,000. On top of that, we are going to add the penalty. We are not going to pay all the amount. You have exceeded the target price, therefore I will apply the 50% on the excess amount as a penalty. How much you are going to pay? 62,500. That means only 2,500 extra you are paying. Remaining amount that is considered as a penalty. Okay, now can you do the case 2? Can you do the case 2, the balance part? Everybody try. How much you are going to pay finally to the contractor? Yes. So we are going to do cost saving happen 5,000. So you are going to apply the 50% bonus. So final amount will be 57,500 because he completed lesser than the target and he's getting 2,500 as a bonus. Okay, that's a way. So in target cost, what happened, as we say, we have to agree the target cost, target estimate, but it's going to be a problem, okay, to agree the target cost because the scope of work is not defined. So there are cost target. If you achieve the cost target, cost saving, there are time target also there. Say sometime if you complete the project earlier than before, then there are some amount need to be paid. Say for example, it's like a five-star hotel. The contractor finished the project earlier than 2 month plan. Will the employer make some profit for a 2 month from the operation? Yes or no? Sure, right? So somehow they have to give per day cost saving. How much? It should be agree. Okay, it should be agree. The target cost target is there or time target also there. So what is the advantage in the target cost? If the contractor do economical thing, he will get some kind of benefits. Okay, and it's increasing the contractor efficient. But there are still disadvantage. Fixing the target price is difficult. If you change the scope of work, that's going to be another problem. You have to change the target cost again. And if you fix the target cost too high, then that is no worthy for the employer. Okay, so that is a target cost. Therefore, major changes, variation are not entertained under the target cost. And cost control also should be very carefully done under the target cost. Okay, so it is very difficult compared to the lump sum and remeasure. Now let us understand the GMB is the last part of the cost reimbursement contract. Look what understood here: cost plus percentage, which is uneconomical; cost plus fixed, which is we control the payment profit to the contractor. Whereas the guaranteed maximum price, there's a no pain and gain. That is a scenario. Mr. Contractor, tell me a price which is a maximum. If the price exceed more than that, you will not get anything. Okay, that is a scenario called guaranteed maximum price. So scope of work should be well defined, but not like a lump sum contract, but the employer agreement should be defined well. So the GMB contract, not a lump sum contract. Many people understood GMB is a lump sum. No, lump sum defines scope of work with the detailed drawing specification. Here, the GMP, okay, scope of work defined by the employer agreement or something other document, which is indicative. Okay, but what they are agreeing, a maximum price, guaranteed maximum price. This is the maximum price you will spend for the project, no more. So when come to the lump sum contract, the employer had a cost certainty. But when come to the GMB contract, employer had a cost limits. It is normally used in the EPC. Yeah, turnkey project is. Okay, cost limit is there. This is the maximum I will spend. More than that, no. Okay. So it is used for a fast track or any project goes under the turnkey in generally. Okay. And if you are introducing any variation, should be extremely minor. Otherwise, GMB will be changed, right? Okay. So regarding the turnkey, procurement route, we will discuss in detail under the pre-contract of the advanced QS practice. There are many people having the confusion what is a turnkey and the design and build. So the clarity will be there. You will understand. So time being, let's understand what is a GMP. The GMP, like at maximum price that contractor, okay, will get. If the amount exceed, then you not going to get paid. So this team structure in the GMP and the it's like a say for example, you have the GMB 100 million. Okay, contractor all the costs including the prime cost and the fixed fees come 80 million. How much you will get? 100 million is a GMB, but contractor all cost comes 80 million. So how much he will get? How much? Everybody. Including the profit and overhead fixed fee, 80 million he done. But target cost was 100 million. Oh, how much you will pay for the contractor? Okay. He will come up to the 80 million cost reimbursement, not more than that. Now contractor finish the work by 85 million, including the overhead and profit. Now how much you will pay? 85 million. Huh? 85 million. Contractor finish the work by 99 million. How much you will pay now? Now contractor finish the work by 102 million. Now how much you will pay? Okay, 100 million. See, he can climb up to 100 million. If it is exceed, he will get nothing. Now let me ask you a question. So he can go up to the 100 million, right? Do you think contractor will stop the wastage up to the 80 million? He can still try to recover the 20 million, right? So still that problem is there. Okay, still that problem is there. But somehow, okay, compared to the cost reimbursement, which is or target cost, the GMB giving the a peace of mind to the client. At least cost is limited, will not exceed. That is a peace of mind. Okay, but it is not a lump sum. Okay, lump sum you have to pay all the amount. In the GMB you will pay up to the amount we agreed. So that is a difference. If you want to understand the difference between the GMB and the lump sum. So therefore, I have to ask you a question. Cost control, design to cost or cost to design, where the budget is fixed, design to cost or cost to design, DC or CD. Okay, the design to cost mean you have to meet the cost target. Where the cost to design mean you have done the design, you have to tell me how much cost for this design. Okay, so the budget is fixed in the DC, not the CD. Okay, and in GMB we have the structure. These notes I just put for your reading. Okay, so since you understood, I don't want to read these notes. Okay, no pain and gain as we discussed. Okay, so it will go in simple way. So now so far what we understood, a type of contract where we have the lump sum and measure and value and the cost reimbursement, and there we had a two variant and three variant actually, but third variant is not a right theory. And the measure and value contract we had a three variant, and the cost reimbursement contract we had a four variant. Okay, so these are the overall summary. And if you see the risk factor, where we have the high risk to the client, which type of contract? Cost plus, especially percentage one. Where we have the big risk for the contractor? In a lump sum contract, not just lump sum, based on the drawing and specification, where the BOQ is not there. So where we have the reasonable risk sharing mechanism, which type of contract? In a measure and value contract, right? That's why we have said measure and value contract, kind of a fair and reasonable contract between the parties. So we had a now very clear idea about the all the contract type, isn't it? So using this idea, now tell me an answer. Is it same when come to the different payment mechanism? The payment and variation claims are going to be treated in the same manner in each and every project? Is it applicable? Now you people got the eye-opening answer. Okay, so yes, you have to now practice in a way you learn. So with that, what we are going to do next lesson, whoever continuing with the program, we have a next lesson. They are using this knowledge. We are going to study about the payment related issue in the construction. Okay, and we are going to study about the type of payment arrangement. That is not a payment mechanism, payment arrangement. Then we will discuss case flow, how to do the case flow forecast and objective, and how to do the payment based on the FIDIC 1999 Red Book, and type of payment application, and interim payment application, progress report. And when come to the interim payment certificate, the FIDIC had its own interim payment certificate format, which is hidden. We have to take it out. Okay, so we will, there's a series of lecture we have to do in order to understand how the FIDIC was hidden its format, and we have to take it out. If you can take it out, you know how to do a payment very well in your project. And certification, when come to the certification, okay, all the thing including the delay payment or holding the payment or how to certify the payment, we have to know. And statement at completion. Statement at completion is a not a final account, but it's a final, okay, interim payment application. Then you will come to the final account where, okay, you done the defect liability period. So what to do and how to do. And suspension termination, they are also payment provision. So these all are connected with the FIDIC 1999 Red Book. Okay. So while we are learning the construction payment, you are going to cover FIDIC 1999 Red Book, something like you are went through with the FIDIC class. But while we are having the knowledge on the type of contract, without the type of contract, you will not have the clear idea about the payments. So as we are part of the these programs are part of the advanced QS practice, which we are having the challenge of the RICS. One thing we want to tell you initially, the advanced QS practice and contract management, we are planning to do the virtual training. What is a virtual training? Whatever in the syllabus, we want to see practically how to do. Because many quantities we have never had a chance. Yes or no? Never had a chance to work. So we are building that virtual training, but it will take time. But only the people in part of this program will be allowed to join that program, because that is exactly whatever we learning under the AQS&CM going to be practice. Okay, but this concept will come soon. Okay, it is very effective, and so many people waiting for that one. And when come to the RICS, you people have to have in mind, okay, the time and the cost. There are two factors we have to carefully observe. Okay, there are some people wasting the time on the RICS, which is the time cannot be reversible. Okay, time cannot be reversible, but the amount whatever you invested to finish it quickly, that is reversible. So with that, what we are going to have in our RICS APC process, US for QS, we don't want to talk to each and every thing what we are going to do. What we are going to talk, join and get the result. So in between, what we are going to see, that is our hidden formula. We are going to treat each and every student as a one individual project, and we had already a result oriented achievement, and every projects are keep it as a confidential for us. So every student joining us, okay, their process will be very confidential and no one visible what they are doing until they get the result. So you are going under the very silent mode and with the effective process. In this process, you will not waste your time. Most of the time, the people are wasting the time themselves by many chance. So some people have some job issue, family issue, some other practical issues. They are killing the time. But from QS for QS, we don't entertain the time delay. We want the result by 2025. So it's a very big task. So every single one of you joining will be treated as an individual project. So through this program, what we have achieved so far, okay, result oriented and really workable MRICS, okay, within the shortest time. And remember, this kind of program, have you seen anywhere? Have you had a chance to learn anywhere practically? Now, if people attended 2 lessons, right? How do you feel that one? Is it giving the eye-opening knowledge for you to work very confidently and confidently? What do you think? So the same pattern we have to learn. It's not just a, having the title. It will not help you. Listen to me. If you just having the MRICS title, it will not help you at any way. You can see so many MRICS after they become a MRICS, they don't know how to do, and they stuck where they have. Okay, they never grow. So what we want, we have to have the very solid idea. Now what we discussed so far, only 3 line item in the advanced US practice in very depth. This is the knowledge precise for you, and nowhere available outside in the market, and nobody's there to do this one. It's all a secret formula of your profession, right? So what I am going to do for you, rather than say what we can do for you, we are going to just deliver the result to you. We want everybody the result, isn't it? So rather than talking the process, let's talk about the result. Within short time, we want to achieve this. So we are working very hard work, and dedicated things to achieve this goal. So anybody want to be part of us, we are not going to compromise with your quality or deliverable. Okay. So reach my team, don't reach me, reach my team, and they will assist you how to join. Okay. So it is your decision now. You want to grow, or you have the excuse, I will come later. Some people are reaching me, I will come after some time, but it never happened. Time will not return to you. Okay, remember, if you want to do it now. There's no tomorrow. And when I start the CPD, I see around 1060 candidate registered for today type of contract. Thank you for all of you attending, and it was a great session. And if you have any question, ask me through the personal WhatsApp I have here, so I might respond to you. Okay, maybe if I'm taking time also, I will come back and respond to you. Okay. And as I mentioned, this is a CPD on type of contract I am delivering as a final, and this CPD no more available as a free CPD in the future. Okay. Why I did that one? Because even though you are joining us or not, but since you got the eye-opening lesson, it will be very helpful for you to manage your upcoming projects when come to the payment variation or interview, or if you are studying your contractual things. It is very helpful to have a very good solid idea how to handle, isn't it? Do you agree with me? Okay. So another thing is, whoever want to join this time rather than wasting the time to join with the next batch or something, because this program, which is advanced US practice itself, uh, very valuable and worthy, but we are offering a very nominal price and affordable, and it's going to work for you. Okay. A lifetime, say for example, a lifetime you are getting a one time to attend this, and it is all about your profession. Nobody there to help you in this pattern. So whoever want to join, reach my team or reach me, I will direct them to have a connection. And welcome to see you with our 1000 MRICS goal. So with that, thank you everybody for joining today CPD, and I will invite you for another upcoming CPD in the future, but not definitely on this topic. Okay, it never going to return at any cost in the future. So very thankful for everybody joined today, and I hope you learn a lot of things, and hopefully you will receive a recording also along with the email you are getting after 1 or 2 hours. Okay, so good night to everyone, and see you all in the upcoming CPD and the RICS goal. Thank you very much.